Hello, welcome back. We're taking a look at Uber, which just reported earnings and it beat estimates as revenue and bookings see double digit growth. You will notice here that the company had revenue that was up 15% from the same quarter last year. It's up to $9.94 billion right now. And we can always be taking a look at our tool here with the Q4 quarter, and $9.94 billion is what they made. Now, in more details here, you will see that the CEO of Uber, says that they have achieved a sustainable, profitable growth for Uber as consumer spending continues to shift from retail to services. It's interesting to see. And the company beat on earnings per share quite significantly, 66 cents versus 17 cents. So that's a massive beat here. And a revenue of 9.94 billion versus 9.76 billion, also a beat as well. Now, the interesting thing to notice is what we are expecting for the company to do in the next quarter, which is obviously usually the most important thing out of this earnings report because it's the future, the guidance basically. For the first quarter of 2024, Uber expects to report gross bookings between 37 billion and 38.5 billion, which is right about where the estimates were, maybe a little bit more the top number because they were 37.4 here, and they anticipate adjusted EBITDA of 1.26 billion to 1.34 billion. And when you are hearing adjusted, you always need to remember that I've made a dedicated video. Usually, adjusted means that extra expenses are excluded. So when you are hearing like adjusted earnings and things of that sort, if you want to learn more, you can always listen to what they have to say during the earnings call. But usually they tend to exclude some expenses, is what adjusted typically means. Now, the number of Uber's monthly active platform consumers reached 150 million in its fourth quarter, up 15% year over year from 131 million. So at least the user base of Uber is definitely growing here, which is always nice to see. And there's a breakdown here in some business segments as well, in case you are interested. Now, there are the usual concerns about Uber, and for a company of this sort, one of the things that concerns me a lot, and this is Airbnb and Uber, I would say, is potential bans. And I was taking a little bit of a look at that, like 14 countries where Uber isn't available, for instance. And you can kind of see a summary of countries where, in some situations, in some locations, for instance, there are some bans, like China, for instance, here, Switzerland, and the likes. So it's not anywhere. It's not everywhere, pretty much in the world, and that can actually hinder its growth in some situations. Now, that doesn't mean that the company is not a buy, of course, but it's always useful to pay attention to things of that sort. And I've seen that with Airbnb as well when I was taking a little bit of a closer look at how it's doing, or what it's doing, and what it's supposed to be doing in the future. And there are some concerns there because they pretty much the hosts tend to have increased the prices that they charge for, and they're approaching hotel levels. And in such situations, there's basically no merit, there's no reason to actually book an Airbnb. And I don't know if this is going to happen ever with a platform like Uber because it's different. It's the cost is much lower, and it's a short-term commitment. Basically, it's just moving around, and potentially, I don't think that this kind of cheap factor is going to go away because it's basically the competitive advantage. But it's always worthwhile, thinking about these things. Now, the company, you can see here, the net income has been increasing, and some quarters has been negative. If you take it to the annual period, you can kind of see that although the company has been growing in terms of revenue, they haven't really been profitable. So they were losing money, and this happens a lot with companies, obviously, especially when they are in the growth phase, and you can anticipate that to happen. But the thing is, as an investor, you want to buy these companies when they are at a nice valuation. So you don't just want to be buying them because there is the potential of growing in the future. You want to be buying them because of that, and because at some point they are cheaper than normal, is what you want to find. And this is how you tend to get great returns. Example of that was Meta, where you actually know that the company is growing great, the company is making tons of money, and you buy it when nobody wants it for various reasons, usually sentiment, and then you make some good money out of it. Now the metrics, and today after the earnings report, the stock is down. Now that doesn't mean much, obviously. I mean, these things have a lot to do with guidance. In some situations, maybe they expected more, and the Wall Street reacts like that. Again, the price of the stock is not really indicative and significant of what the company behind it is doing. The only service that the price of the stock has for us is basically that it gives us an entry to the company, and we want to be getting as much of a better price as possible, obviously. If you take it 5 years, and the company was a 2019 IPO, so it's like 5 years old pretty much since its IPO days. So we're basically seeing the whole history for the most part here. And you will see that the company has been growing, but not really at a tremendous pace, and it had its its down moments as well, quite significantly. So again, when everybody for the most part had them though, so that may not be extremely significant for the future of the company. But now it's sitting at its all-time highs, which is interesting to see. Whenever a company is at its all-time highs, there are two important things to remember. Obviously, it's expensive, so it could be, actually not necessarily, but it could be expensive compared to where it was in the past. And the other thing is that there is no resistance. So at these levels here, everybody who has basically bought in the past has sold already if they wanted to. They are not back holders, so nobody is actually waiting on a specific price to sell the stock, because this price hasn't been achieved before. There are no back holders, and usually this means that there is not enough selling pressure to make the stock go down significantly, or at least make it stagnant. So if the business is doing well, it has the potential of continuing to grow. Is what I wanted to say, and there's not much resistance towards that. But again, it has to be a good company and a cheap company in order for something like this to happen, and has to continue doing well, of course, obviously, in the upcoming quarters. Now, the company's P ratio is expensive, 135, and the price to free cash flow is a little bit better here after the adjustments. With the outstanding shares of the stock at $2 billion, and this is obviously at 2 billion shares, but this is obviously a thing that you don't want to see, an 80% increase since its IPO days. Now, there is a bad thing about this, and there is a good thing about this. So people who bought here have been diluted massively, and dilution can be a good thing if the company grows, and if it grows beyond its dilution, especially when the stock price is expensive and the board keeps selling. It can be good, but it also dilutes you as a shareholder, and you being a shareholder, you basically want the opposite. You want your stock, your shares to be worth more, so that you can sell them for more. Now, again, if the company keeps growing, then this has some merit, because you could be gaining more value per share, so more earnings per share in the future. But again, if you bought here, you basically have double the float right now, and it's not great to see. Now, in the past 2 or 3 years, it has been quite steady, like a little bit of issuance here, but not that much. There's still some, but not that much compared to what happened back in 2019, for instance. So something to note, but it doesn't seem like Uber would be issuing tons of shares in the future, similar to the pattern that we saw here. So probably not much of a concern, but definitely a concern for the past, for sure. And the fact that, again, it becomes a little bit more linear here, if not steady, is good to see. But we don't like to see the P ratio of the company, the price to free cash flow, and the liabilities compared to the free cash flow, definitely indicating that the company has quite a few liabilities compared to how much money they are generating here. And if you take it to more detail here, you can kind of see it in its income statements. The company has been achieving revenue, and good revenue that is, but the net income has been negative for many years. So it's a company that has been striving to become net income positive, and they have managed. So things are looking better definitely than what they used to be. But again, for these kinds of companies, you typically want to buy them at a cheaper price, is what I want to say, just to mitigate the potential risk that you have from holding a company that is not like massively profitable. Now, you can kind of see here, and the balance sheet of a company is very interesting to examine, and especially this kind of layout that we have here in our tool is very useful, because you can very, very quickly see what the company is doing, how much, for instance, they are making in additional paid-in capital, which is basically the issuance of shares, selling more shares here and making more money out of it. And you can kind of see that the debt that the company has, and how it has been increasing through the years, from 5 to 7 to 9 to 11, for instance, over here. and the total liabilities also increasing from 13 to 23, with the total equity pretty much going down because of the liabilities for the most part, and initiated at about 10 billion back in 2018, I think that is, and it's about 8.5 right now, so it's going a little bit lower. All these things are very interesting to see and examine what the company is doing financially. Now, in regards to its operating cash flow here, after all cash expenses are accounted for, the stock-based compensation, a typical thing for companies of that sort. Uber wouldn't be different, obviously, or the CA companies, pretty much, Bay Area companies. And you will see here that after all the adjustments, we are looking at 3.5 billion in operating cash flow. And after you can kind of see, let me find it over here. You will see that after the capital expenditures, which are not too many, obviously Uber is not a company that would have massive capital expenditures, then their cash flow at the end of the day, their free cash flow is at about 3.4 billion dollars. So it keeps increasing through the years, which is nice to see. Now, this gives us an idea about the company pretty much having quite some debt. The company is a little bit more expensive than I would like, but how much expensive? The stock evaluator tool will tell us exactly. And right now, sitting at $70. So where would I want to be buying this at? Now you will see that the revenue growth that the company has been achieving has been high at the 30% range. I don't want to go that high because I want to be more, less aggressive and just account for potential risk. Obviously, in your calculations, if you're a patron, you have full access to our tool here at myinvestorsheaven.com. You can do your own calculations the way you want them, but for my case, I will go 10, 12, and 14% here, which may already be quite some for the next 5 years. And the net income margins is a little bit of a problem because it's only the past year that the company made 5%. Now, I do anticipate that this could increase as the company approaches, and reaches better profitability. This happens a lot, so it hasn't really stabilized. We don't know exactly how much is their margins, their actual margins is going to be as they keep growing. So this is a little bit of a playing field here. So I will go with 5% for the low one because I think it will grow, and then I will go 7 and 8, and let's go 9 actually. And again, I don't know if they are going to achieve it. The margins are really, really dependent here, and they can change rapidly because again, Uber is a company that relies on being cheap in regards to when compared to actually taxis and cabs around the Europe or the US or the world pretty much. And the free cash flow margins that I'm going to use, about 100%, 85% makes sense, 80, 90, and 100. And typically ask for 13% for our potential gains. And I hit calculate here, and with these values, we're sitting at 15, 26, and 40. 40 being the highest here for revenue growth of 14%, margins 9%, and basically converting the free cash flow to pretty much the net income margin, like that would basically be 9% free cash flow margin. It's the same, like 100% of the net income margin. So as it is right now, I think it's expensive, like Uber. It could continue growing for sure. It could continue to grow basically, but the stock price is a little bit problematic here, and I do consider that there are some potential risks here for the company. I do like the fact that they are sitting on their, on the all-time highs from the perspective, again, that I mentioned earlier, that there are no back holders. But I just can't be buying, I don't want to be buying companies at this valuation. And especially when there is quite some risk around them with the risk that I explained earlier. So I could potentially probably avoid this one. I do see some potential merit here for a company of this sort, but if I were to be buying this one, I would look for a deep, deep discount. Frankly, I would want it to be potentially around $25 to $30. I think there it would be a fantastic situation. This would be a very, very interesting case. But when it's sitting right now at 70, I think it's overly expensive for my taste. So I would probably avoid. But thank you for watching, guys, and I'll see you in the next video. Bye-bye.